Good evening, everyone. I welcome you all.
Lalit bhai.
Hello.
Lalit bhai. Good afternoon.
Shiv sir, can you hear me?
Yes, we can hear you. Please continue.
Yes,
Yeah.
Swapnil, you are audible.
Put
Good
everybody
evening,
on
everyone.
mute and then speak. Put everybody on mute and then speak.
Good evening, everyone. I welcome you all to the final episode of our seminar of our part 2 of Local for Vocal, which was then initiated, which was
Lalit
coined by the
bhai.
Thane branch of
Good
ITI. We acknowledge the presence, before moving ahead, we acknowledge the presence of Preeti Madam, CA Preeti Savla, CA Lalit Bajaj is with us, and CA Srinivas Joshi, the Central Council member. And we thank them for
Lalit
sparing
bhai,
the time
good
and having
afternoon,
coming here with
welcome.
us.
Good afternoon, madam. Introduction होने दो बाद में please don't disturb.
So, without any further ado, I would without wasting any further time, I would just request Srinivas sir, would you like to give any opening remarks in short, please?
On this subject, yes, if you allow.
Yes, sir, please.
Yeah. Good afternoon to all, Chairman, Thane branch, whole office team, our today's speaker, our immediate past chairman of WRC, Lalit ji, Preeti Madam, and all my colleagues, our speaker of the day, Vijay Kevalramani. Friends, this is a very difficult time. All of you were speaking about it prior to this seminar, but I'm not speaking on that. In this time, we are thinking of newer avenues for this, and how we want to know how we can grow our practice or how we can at least survive in the practice. Some of them are on 2 levels, some of us. I think if you are looking at the practice currently, the subjects are networking, automation, and specialization are the only 3 words on which we can survive because this will give us all the fillip required for the purpose of our practice, the networking, automation, and specialization. As a chairman, current chairman of CLCGC, that is Corporate Law and Corporate Governance Committee, and also as a company secretary, which I have passed in addition to CA, when I was as young as when the introduction was given, as young as all of you, I feel that we were doing lot of practice in company law. In this corporate law committee, we have company law and LLP both covered. And today's topic is LLP. We were doing lot of practice in company law, even though that time LLP was not a concept. But I think over the period, we lost it to chartered company secretaries. And we are not thinking of that as a practicing avenue. I think today you can think of that as a practicing avenue. You can see the weekly announcements by the CLCGC. You can have monthly updates. You can look at various groups that we are making for the updations and also of updating the laws, amending the laws. So I will just request you to look at company law, corporate law, LLPs, or valuations as the subjects for our practice. I know today's speaker will do the best because Vijay Kevalramani has been speaking on this subject for ages, as far as I know. He has also written a book on this particular subject. Knowing his expertise, friends, we have 2 groups made recently on the request of Ministry of Corporate Affairs. One is on amendments to company law, where we are to make it simplify the company law for foreigners to be getting attracted to India. So first is on company law, and second group is on LLP. How we simplify the procedure to form and work in the LLP format. And considering the expertise of Vijay Kevalramani ji, I have requested him to be in the group, which he has kindly agreed. And we will be helping government to simplify this particular 2 laws in future. So I think with this, and I'll also request you at the end to look at various publications. Now you must have already read the publication by Vijay Kevalramani ji on LLP FAQs. So I think similar publications have been given even by the institute. There are several publications which I will draw your attention to on various, Schedule 3 and related party transactions, Section 144, etc. in addition to LLP. So I think all of us together would work towards New India, and all of Vijay Kevalramani has been a part of that for years. But I will request all of you to be a part of this particular initiative of the committee or any other thing that you want to do for the profession. I'm with you. Thank you, friends. Thanks a lot for being with us. Thank you. Over to Polte. Hello. Sir, you are on mute. Asava sir, you are on mute.
Okay.
Speak. You can speak.
Am I audible now?
Yes, you are audible now.
Okay. Dear members, a very warm welcome to all of you. I really appreciate that you have taken the time out for this session on a Sunday amid the chaos of this pandemic. As you are aware, this is our second series under the Vocal for Local Speaker series. And today is the last day of 3-day series by our very own and man having omnipresent CA Vijay Kebal Ramani ji. Idea behind this series of local speakers to promote networking among us so that we can physically connect with the speaker maybe after the lockdown restriction is over. I recognize today our presence of CCM Srinivas Joshi sir, RCM Preeti Savla ma'am, and immediate past chairman and RCM CA Lalit Bajaj sir. CA Bajaj does not require any formal introduction. We know as a chairman of WIRC, he has delivered stellar performance and led the region in the best possible way. Without taking your further time, I request RCM CA Lalit Bajaj to share his words of wisdom. Thank you. Over to Lalit Bajaj, sir.
Thank you, Chairman Shiv Bhagwan Asawaji. The whole team led by Shiv Bhagwan ji. My respected Central Council member Srinivas Joshi ji, my colleague in the council Preeti Savla madam, the expert on the subject Vijay Kebal Ramani ji. I am first time sharing dais with Vijay ji. I am fortunate for this. And all the members of the branch and other members who are attending this program at the outset, thanks for giving me this opportunity to be with you. First of all, congratulations branch for coining out with such novel idea, whereby we are looking forward to promote newer speakers to share knowledge with the members. That is a great thing which you are doing. When I think of Thane branch, let me share with all of you. Thane branch has a huge experience with its long years of existence, with central council members present and past, regional council members present and past. And with this, I mean to say that the members of the Thane branch are really fortunate that whenever they need any kind of guidance or support, I think so our leaders, our seniors in the branch are always there for each one of us. When I talk about activities of Thane branch, generally for any institution, any organization, the activities resemble the aspirations and ambitions of all the members. And when I talk about Thane branch, I can very well understand that all the activities of the branch are really showcasing the aspirations and ambitions of the members. And I believe that all the members might be giving their opinions, their ideas to the branch so that they can work effectively in the same direction. That is the purpose for which we are working at a branch at Regional Council at ICI. When I talk about technology, in the last 1.5 years, during this period of work from home, we all have understood or have been to some extent have been well versed with various technological usage at our individual practicing area. Now we are at a stage whereby I think so we have to enhance the use of technology so that we can provide best of the best services to all the clients. I mean to say that we all have been engaging into various technology related seminars, attending those. But in near future and presently, I think so we have to upgrade ourselves as to various things, various newer things happening in technology, because industry is expecting a lot. there are no signs of looking back when it comes to economy or industry. We chartered accountants have to gear ourselves, and I think so branch will surely ensure that we can conduct sufficient number of activities related to this. We all are somewhere or the other engaged into traditional practice. Lately, it has to be very well understood and accepted with the various changes made by the governance and with the various changes happening in the economy. We as practicing chartered accountants, as small and medium practitioners, have to somewhere transition ourselves from traditional practice to value-added services. It's not something whereby all of a sudden we are supposed to change everything, but I strongly recommend that slowly and gradually we have to invest our resources in developing the capability in providing value-added services, so that gradually in a couple of years we will really be able to serve our clients in those areas. This was I wanted to share with all of you. One more thing which I look forward that I should share with the members which are present today is, after post my chairmanship, I have been focusing on my office in last 3 months. And during this pandemic also, I have observed that corporates in the wake of cost cutting are looking forward to us chartered accountants in outsourcing various activities, various processes of the corporate. What I mean to tell all of you by this is that there is an opportunity lying with corporates for us professionals when it comes to outsourcing. I think so. Just think on it. Just try to brush upon your contacts, those who are there in corporates. There might be some of the other opportunity lying for you. You need to move ahead and speak about it with the known people whom you are in connect with. Couple of things which I feel that we chartered accountants are on a back foot. When I talk about due diligence, I see that there are very few chartered accountants who are expert in conducting due diligence. When I talk about systems audit, there are very few chartered accountants, those who are really engaged in systems audit. Or when I talk about data science, there are very few chartered accountants, those who are engaged into this activity. I look forward that all my members, all my friends really go through various seminars, go through the digital platform provided by ICI, whereby there are various programs related to this. Also, Thane branch is eager to conduct such kind of programs, because I had a word with Chairman Shiv Bhagwanji and he is planning seminars related to this subject. I believe that we all will be benefited by this. As far as today's topic is concerned, we all understand that when it comes to LLP, there are various convenience as far as compliances are concerned. There are various acceptability comfort that we are getting when we form a LLP rather than a partnership firm. Over and above this, I think so we have Vijayji to share various nitty-gritties related to this subject as on date. I am really thankful to each one of you for giving me this opportunity, and I am looking forward to get more and more opportunity to interact with all of you on various occasions. Thank you, Srinivasji, for guiding us in today's session.
Thank you so much, Lalitji. Before moving ahead, I would like to acknowledge and thank the Thane Janata Sahkari Bank for being the official sponsor of Thane branch of ICI. It's because of the TJSB Bank we are able to conduct a lot of events at the most efficient cost. So we would like to acknowledge their efforts towards us and acknowledge their contribution towards us. Again, as this is the last event, I would also like to thank our chairman, Shiv Bhagwan Asawa, for single-handedly organizing this entire event and for having such a wonderful speakers and for initiating and coining the concept of local for vocal. We'll be coming up with the next session, the season 3 for this in the next month itself, and we'll be continuing with this. We would also encourage all the speakers, all the participants who wish to be speakers, kindly write out to us, kindly reach out to me, Shiv Bhagwan sir, or any of the branch members, so that we could organize your seminars over here. At the end of the day, if you could grow, we would love to grow together. Before any further ado, I would request Rahul Gharat, CA Rahul Gharat, to give the kind introduction of our today's speaker, CA Vijay Keval Ramani, sir.
Thank you, Sapnil. Today I'm glad to introduce you our today's speaker for Local for Vocal. Last session on topic LLP New Age Business Model. None other than CA Vijay Keval Ramani, sir. Sir has been practicing CA with experience over 2.
Rahul, are you there?
Swapnil, I think he may have lost his audio network connection. Let's proceed. Vijay ji is
Let's proceed. Vijay ji does
very
not
well
need
known
any
to all of
introduction.
us.
Yeah. Vijay
He
does
know-
not need any introduction. He's a very well-known chartered accountant in the Thane city who has been helping out young budding chartered accountants as well as the senior chartered accountants with various issues, mainly concentrating over income tax and technology. So without any further ado, Vijay sir, please take over. We are eager to hear you out.
Thank you, Swapnil. Thank you, Chairman Shiv Bhagwan ji, for inviting me to present a talk on this one of my favorite topics, which I have been delivering. And I would like to thank our CCM Shri Srinivas Joshi ji for taking out this time and being present over here. I would also acknowledge the presence of our past chairmen of Regional Council, Preeti Savla ji and Lalit Bajaj ji. Friends, LLP per se, as we all know, was a concept. It started somewhere in 2009, but we did not take heed to that. We were not taking much cognizance of that until all of a sudden at 12 o'clock in midnight, there were huge amendments passed and a new Companies Act 2013 was passed. Then we all professionals stood up all of a sudden saying, "Arey, ye to gadbad ho gayi. Now we need to look into some other avenues." And that was when people started looking into LLP. Although LLP Act has been there since 1st of April 2009, but very few people used to look into it. There are many advantages. So this is when we started speaking about why and how we should use LLP as a new age business model. I know my interactions with many people when we used to discuss, अरे we don't know LLP, हम तो Companies Act ही बताते हैं, client आता ही नहीं है, people don't come to us with LLP. I said, भाई, clients are coming to you with a requirement to form a entity. You have to understand his requirement and based on that you have to give a suggestion. The point was we were there ourselves not ready as professionals to guide them. And so when all the Companies Act 2013 came into force, all of a sudden, because the compliances became heavy, penalties were heavy, although they have been reduced quite a lot subsequently, then everybody just awoke and then everybody started looking into LLP. So friends, what we would be looking over here is we will be doing some insights. We'll understand what the LLP stands for, what the LLP Act says, and we'll also go a bit beyond what exactly is not there in the Act, but we'll try and understand what documentation should be kept for a LLP. Like in a Companies Act, we have documents prescribed like board report, board minutes, AGM reports and all that. Unlike in a LLP Act, nothing like that is prescribed. So we look into how the processes should be followed, which are not there in the Act, but standard processes, and also the documentation that should be kept, which will help us for maintaining our records. So can you please mute whoever is speaking? Sorry, friends. So let's continue. My presentation is visible, right? The presentation is visible.
Yes, Vijay ji.
Yeah. So friends, as happens, there were some talks going since 1993 that we should have a new corporate law coming in because Companies Act is a bit tedious and the partnership is not giving the benefits. So something midway should be coming. So there were various committees formed. since 1993, and ultimately there was a committee of Naresh Trehan which suggested that LLP should be brought in for professionals. Then the industry got up, why only professionals? Why not us? Then a separate committee was formed called as JJ Irani Committee somewhere in 2004-5. The JJ Irani Committee went into it, and then they proposed the current LLP Act, which was then put into Parliament, and it was passed in December 2008, and the rules were notified on 1st of April 2009. So that's why the act is called as a Limited Liability Partnership Act, as it was passed in the Parliament in December 2008, and the rules were notified. So the LLP Act was notified with effect from 1st of April 2009, and with the notification of the Limited Liability Partnership rules, because as we all know, any act cannot be notified until you have the rules to work, because rules are the basic functions which help you to work and based on which the law applies. So we'll initially understand what are the salient features of the LLP, and then we'll go into all these aspects into a bit. So the first and foremost benefit is it gives you the benefit of both a company as well as a partnership. It gives you the benefit of a company that you have limited liability. You can have directors, means designated partners, now known as directors here, and then the liability of the partners, which normally was unlimited, it is there, and then every partner used to be liable for all the defaults of other partners, so that is not coming vis-a-vis a company. So at least the amount persons who are investing in a LLP are secured, as well as you got the benefits of a partnership, that whatever you work as a partnership, you have all the roles of a partnership. The profit sharing is based on the partnership, and there is no taxation of a partnership under the Income Tax Act. Also, the share of profits come to you tax free. Best advantage was that you get a separate legal identity for it. So it has a separate legal identity, because there were doubts many a times partnerships were not registered, so they were not treated as legal identities. There are judgments which treat it. So this LLP gives you a legal identity. In a partnership, there was an issue of succession, because if there are only two partners and the last surviving partner dies, then what happens? So LLP Act has taken care of this. We look into all these details subsequently. Then foremost is the name itself suggests it is with a limited liability. So the liability of the partners in the limited liability partnership is limited, unlike that of the partnership firm. You can start with minimum two partners. At least one of them should be Indian resident, mandatory. Friends, mind you, one of the shareholders to be Indian residents and one of the directors to be Indian resident was made mandatory by the Companies Act 2013. But as back as in 2008, the LLP Act stated that one Indian resident should be a partner. That is mandatory, because in somewhere in 2006-7, there were a lot of vanishing companies that had happened. To control that, this effect was given. So before it came into the Companies Act, it was incorporated into the LLP Act. This is the biggest advantage. You have no maximum limit on the number of partners. As in a partnership, you have a maximum limit. Banking company, you have 10, otherwise you have 20. But here you have no maximum limit. Again, if you go vis-a-vis the company, a private limited company has an upper limit. Earlier it used to be 50, now it's 200. But here you have no this thing. And then individuals, LLPs, companies can be partners. A new concept of designated partners was introduced. Friends, we look into this. It is very important to understand this concept, because still there are misconceptions about the role of a designated partner. Partners can be agents of the LLP, but they cannot be agents of each other, unlike in a partnership where the partners are treated as agents of each other and they are liable for the gross negligence or the mistakes committed by the other partners. Here the other partners are secured. They are, because they are only agents of the LLP and not of each other. And then, as we have written up, that it's a perpetual succession. So to take that into forward, they have given a time of 6 months to admit new partners in case the number of partners go below 2. If there are 2 partners and unfortunately one partner dies, So the other remaining partner has 6 months to bring in a new partner, and the LLP would survive. It may not be dissolved. Audit of a LLP is mandatory only if there are conditions fulfilled. We look into this. These numbers are important, 40 lakhs and 25 lakhs, which we will look later. But please take care that these numbers are important. Audit is important. So having understood the salient features, we move forward. So who are the partners? Who can be a partner? Let us understand. Minimum 2 partners, as we saw earlier, you need a minimum of, because until you have 2 partners, there cannot be a partnership. At least one has to be an Indian resident, mandatory, and I told you the reasoning for this and why it was introduced in the LLP Act 2008. This is the advantage that you have no limit on the maximum number of partners, so you can have n number of partners. The only issue is how do you manage that can be sorted out. That's not a problem at all. And it is also important to understand who can become a partner. Either an individual can become a partner. Then the question arose in an individual whether a minor can become a partner. So clarifications have been given that minors cannot become a partners, only individuals who are eligible to contract, that is an adult individual, can become a partner. Companies can become a partner, or LLPs can become a partner. That is basically, you can say 2 types of people can become a partner. It is either an individual or a body corporate, because LLP is also deemed to be a body corporate like a company. So HUFs cannot become a partner, trust cannot become a partner. Please take care, only individuals and body corporates can become partners. And what are the disqualifications of becoming a partner? A person of unsound mind, because he is not eligible to contract. It goes by the Contract Act. A person declared insolvent. And again, friends, the last clause which was introduced in the LLP Act, subsequently in the Companies Act, a person who has even applied for insolvency cannot become a partner. So it's not only that you have been declared insolvent, but even if you have applied for insolvency, you cannot become a partner. So we just understand the differences between a partner and a shareholder. In a company, you need minimum 2 partners or 2 shareholders to form a company. Yes, in a limited company, you need minimum 7 shareholders. That's a different issue, but at least 2 partners are required in a private limited company. At least 1 Indian resident mandatory. Yes, after the amendment of Companies Act 2013, this is common for both. In a private limited company, there is a limit on maximum number of shareholders, whereas in a partnership or a public limited company, there is no such limit on the maximum number of partners. Then who can become a partner or shareholder? As I told you, only individuals or body corporates can become partners, nobody else, whereas shareholders, even HUFs and others, can become shareholders in a company, whereas there are restrictions on being a partner in LLP, only individuals or body corporates. Then we try to understand the role of partners versus the role of shareholders. So what is the role of shareholder, friends? Role of shareholder is just to appoint the directors. At the most, they are eligible to vote in the AGM. That's all, and approve whatever things are to be approved in the AGM. The basic management is left to the board of directors to conduct the day-to-day functioning. Vis-a-vis, if you look into the role of the partners have a whole-time role in the management. They are fully eligible for management. And there's something, you might ask me a question, then what are designated partners for? Designated partners per se, by the definition as per the LLP Act, does not give them a right to run the LLP. Only if they are specifically assigned to run the LLP, they are eligible. Otherwise, we'll understand the role of the designated partner. And I'm sure once you understand the role of a designated partner, nobody would like to become a designated partner. As we are interested in becoming directors and independent directors, here there is nothing like an independent director or independent designated partner. But once we understand the role, nobody would like to become a designated partner in a LLP, because technically they are not by default the managers. the management is with the partners only until they specify that, okay, out of 10, only XYZ 3 will be eligible to run the partnership management, then it's a different issue. Otherwise, by default, it is all the partners. Now we come to this concept of designated partners. Friends, as we have directors in a company, we also have designated partners over here. So what is, again, we need a minimum of 2 designated partners because in case one is not available, the other should be there. At least one of them should be a Indian resident. Again, this condition was incorporated in 2013 for the role of a director, that one person has to be an Indian resident. Now we should understand who can be a designated partner. Only an individual, friend. So even if there's a body corporate which is a partner, they can nominate any individual from their body corporate who will become a designated partner, but they directly cannot become designated partners. It has to be an individual with flesh. Now, friends, what are the duties of a designated partners? This is the only role specified. Designated partners are required to discharge all obligations or compliances as required under the LLP Act. So by default, they are not eligible under management. As partners, they are anyhow into the management, but they cannot say that out of 10, we are 2 designated partners, we have the right to rule. They do not have, they are not managers. Their only right is that's what I said. If somebody understands the duties of a designated partner, nobody would like to become a designated partner, because their duty only is to discharge all the obligations and compliances as required under the LLP Act. And if though it is not done, they are personally liable for all the penalties levied on NLP for contravention. And mind you, friends, that liability ranges from as low as 10,000 rupees to as high as 5 lakh rupees. So designated partners can personally be held liable for liabilities up to 5 lakh rupees. So if you have only a liability on your head, only a responsibility on your head, why would you like to become a designated partner? Now we would understand the difference between a designated partner and a director in a company. The first and foremost is the role played. As I said, directors by default are the management, but designated partners are not the management. They are only responsible for the liabilities and the statutory compliance. And duties and liabilities, definitely directors also have the same duties and liabilities, but they are enjoying a lot of other benefits. So this is the basic difference over there. Now we come to another important aspect, that is the contribution or the capital that we call in a company. What is the contribution? Initial contribution is nothing but it is similar to a share capital in case of a company. But in case of a company, you have a minimum share capital of 1 lakh rupees for a private limited company, 5 lakh rupees for a public public limited company, and it may grow right up to 2 crore rupees for your NBFC companies, or maybe for insurance companies it may grow higher. But for LLP, you can start with as low as 5,000 rupees or even 1,000 rupees, because there is no minimum initial contribution mentioned in the LLP Act. You can start with 5,000 rupees, no issues at all. Yes, if you want to open it for financial purposes, then RBI comes into being and you may have to bring in a share capital of 2 crore rupees. But otherwise, you can just start with as low as 5,000 rupees or 2,000 rupees. There is no binding. This is one of the biggest advantage. Contribution can be in a tangible form or an intangible form. So you can bring in cash, you can bring in movable property, you can bring in immovable property, or you can say that I will provide services over a period of 3 years. So please value it, and that would be my contribution to the LLP. Like supposing in a CA firm, we induct a new partner and he says, sir, I have nothing, I am a new person, I have nothing to contribute, but I can contribute my services. So you can say that part of his remuneration that he receives will be converted to his contribution over a period of time, can be valued, and then based on that, it can be treated as a contribution. The nature and value of the contributions have to be stated in the accounts. In case of non-cash contributions, it needs to be valued by either a practicing chartered accountant or a cost accountant or a valuer from the approved panel. So non-cash means either a movable property, immovable property, or services, whatever you bring in, it has to be valued by either a practicing chartered accountant or a cost accountant or a person from approved panel. Technically, if you look, as per the Act, no reserve account has to be maintained. Now see, there is a dichotomy. This is what happens when we have a bureaucracy. I am openly saying. The Act says there has to be no reserve account. But if you look into form number 8, which we file for the statement of accounts, it is asking you what is the balance in your reserve account. This is the dichotomy, friends. Bureaucrats do something, they write something in the Act, and what they do is totally different. So there are many controversies and contradictions which I will bring out. This is just one of the contradictions I have brought out. Another advantage is that partners can grant loan to the LLP. Unlike in case of a company, you have restriction on amounts and all that. Here there are no restrictions. Partners, or you can take loan from the relatives or outsiders. Yes, definitely the Income Tax Act comes into being and you have a limitation of 12% as of now. But still you can grant a loan to LLP. There are no restrictions as we have in case of a company for deposits and all that. Friends, the heart and soul of a limited liability partnership is the agreement. Like in a company, we have a memorandum of understanding and the article of association and memorandum of association. Here we have a LLP agreement. And friends, mind you, this is the most flexible document that you will see. There is no pre-described format. You can write anything and everything you feel is important for running the LLP, which is legally acceptable. Please mind the word legally acceptable. So what is an LLP agreement? Section 210 defines an LLP agreement as a return agreement between the partners of the limited liability partnership or between the limited liability partnership and its partners, which determines the mutual rights and duties of the partners and rights and duties in relation to that limited liability partnership. Here, friends, please note section 210 of the LLP Act defines LLP agreement as return agreement. But if you read, when LLP was started, the Act was brought into being. When we used to file, they said even, now this is a dichotomy, again I'll tell you. When you go to the first schedule, it says that LLP agreement need not be in writing, whereas the definition says it has to be a written agreement. So what, again, because of this, there were controversies. So when we used to file the agreement form number 3, where in incorporation during the early days, they never used to ask a copy of the agreement. Then I'll just tell you how the bureaucracy acts in certain regions. So then they said no, a written agreement is required. So we are all smart professionals, be it company secretaries, be it chartered accountants, be it advocates. We used to just fill in form number 3, just on a piece of paper. We used to write LLP, so and so LLP, agreement of LLP signed and attach it, finish. It used to be accepted. Then they said no, you have to write something, the content has to be there. Then we just put a normal content, then was accepted. Then they said no, it has to be duly stamped. Earlier they did not ask for stamping. So then they started, no, it has to be a properly stamped agreement. So this is the correction that they have been bringing in the forms also backend. Stamping and all will come, what are the stamp duty and all to be paid. So what is an LLP agreement? Can be executed before or after the incorporation of LLP. Unlike in a company where before the incorporation of your company, you have to submit a copy of the MOA and an LOA. Here you need not. When you are applying for incorporation, you just apply for the incorporation. Once you get the incorporation, and then you can submit the LLP. You have to submit the LLP agreement subsequently, but the agreement can be signed prior or later. Whereas the MOA or AOA has to be signed prior before submitting for the incorporation. In the absence of the provision of the first provisions of first schedule apply. See friends, I told you this is the dichotomy in the Act itself. The definition says it has to be a written agreement. And here it says in the absence of the agreement, the provisions of the first schedule shall apply. So this is a big dichotomy over there. And then if the agreement is signed prior to the incorporation, it needs to be ratified. If it is signed later, it need not be ratified. So what we suggest to everybody is you prepare a draft agreement, keep it ready, keep your stamp papers ready. Once your incorporation comes in, then you sign the agreement subsequent to that and you follow it. So you need not go into the process of calling a meeting of partners and getting it ratified. It saves your time because the LLP agreement then has to be submitted within 15 days of the incorporation. So you have to save your time. As we understood that in case there is no agreement, the provisions of the first schedule shall apply. So let us understand what does the first schedule say. Friends, mind you, first schedule gives you things which only if there is no agreement or any of these clauses are missing from the agreement, then the first schedule will by default apply. In case whatever is said in the first schedule, you write in the agreement something different, it will be acceptable, it will not be challenged. So there is nothing to worry about that. The first thing that the first schedule says is all the partners are entitled to share equally in the capital and the profits and loss. So if you want a different capital, you want different profit, different losses, you better put it in the agreement that we want to share in this ratio. We will be bringing in the capital contribution in this ratio. Otherwise, if you don't put, this clause is silent in your agreement, then this will be deemed to be equal. Then indemnity clause, if it is not there, it is deemed to be there. Normally, it is always there in the agreement. See friends, this was what I was discussing in the role of the partners and the directors or shareholders. All the partners by default are entitled to take part in the management. If you want to restrict a partner, you have to mention in the agreement. We have been doing, there are certain different things we look into when we go into the features of the agreement after this. So all partners are entitled by default to take part in the agreement. If you want to restrict a partner, please put it in your agreement. By default, again coming to this, by default, no partner is entitled to remuneration. So if you need a remuneration, please ensure that it is put up in the agreement. If your agreement is silent, then you cannot say my income tax 40A allows me to take the remuneration under the income tax. You will not be allowed, friends, because your agreement is silent and the LLP Act first schedule automatically applies in case your agreement is silent, then no partner will be entitled to remuneration. No new partner can be introduced without consent of all the partners. So if you have nothing relating to this, so I am just saying whatever clauses are there, if you have nothing relating to this in your agreement, then these will apply by default. Now that we assume that the section 210 applies and the written agreement has to be there, and any of our formation now we have to have a written agreement. So if any of these clauses are not there, then this would apply. Please take care. All decisions are to be taken with a majority of the partners concerned. Minutes to be recorded within 30 days. So whenever a meeting is held, there is nothing, no procedure defined how to hold a meeting, what to do. But if you have a meeting of the partners, the minutes have to be recorded within 30 days. And if you don't want this also, you can please mention in the agreement, no issues at all. Render true accounts and a non-compete class. And partners cannot be expelled by majority unless prior act. So friend, these are the basic features of the first schedule. And again, as I said, first schedule will apply only if your agreement is silent. If your agreement states about these clauses, it overrides the first schedule. So the agreement is supreme, not the first schedule. Only in case the agreement is silent, the first schedule will come into being. This clause was also there that the disputes to be referred to Arbitration and Conciliation Act. If you want to take it to the jurisdictional court, you can take it that way. It's up to you how do you are recording. Now, friends, when we are drafting an agreement, what are the important checkpoints that we need to look into while drafting an agreement? Because this is important to understand. First and foremost is the objects. Since I am not going into the recitals, we are all professionals. We all know this LLP agreement done between so X and Y on this so and so at so and so so and so. I'm not going into this. I'm just giving you brief checkpoints. First and foremost is the objects. Friends, earlier again there have been quite a lot of changes. Please note the objects are the ones that you have mentioned in your form for application of name. Please ensure that exact wordings are used in the agreement, otherwise it can create a problem. And because when you fill in the form number 3 for agreement, this is what will be picked up. Then you cannot say my objects have changed. And earlier they used to allow unlimited words. Then they restricted it 2000 characters, and now the restriction is 500 characters. So you have to draft your objects to 500 characters. I have seen LLP agreements coming in, ancillary objects, so and so. Please don't do it. They are not valid. And again, I'll tell you then, normally we are used to what happens when we are preparing an agreement. I have seen, and in case of dispute, most of them have been coming to me for vetting, and we have had issues. People just copy, अरे partnership तो है, exactly partnership deed उठा के हमने इसमें डाल दिया. This is wrong. You have to prepare a separate agreement based, because this is a separate act. What we do is we just based on a partnership. So in a partnership, when we prepare objects clause, what we write, and or any other object, the partners will mutually agree. The moment you put in, it will be rejected. So please ensure that such words are not there at the end of your object clause. And when you enter there, the objects are carried over in all your forms by default, until you change the object specifically later by amending the agreement. Then it should have the registered address, where it is registered. Contribution. What would be the contribution? Friends, contribution, again, there are a few things I would like to say. You can have a staggered contribution. It need not come in at one place. So supposing you are doing a building project for a builder, and then they write that our total contribution would be 2 crore rupees, but we would bring it on an event base, that we would initially form the LLP with say 5 lakh rupees, and then when we acquire the land, we will put in 50 lakh rupees. When we do the foundation, we will put in another 10 lakh rupees. When we do the first slab, second, so you can do that also. Please mention there how it will be coming. Your total contribution would be 2 crores, but you can do it in a staggered way, no problem at all, and you can bring in money based on the events. You need not worry about bringing the whole 2 crore rupees initially. But friends, please mention in your LLP agreement how you will be bringing. Then you also put in the mode of contribution, which we already understood earlier, that it can be cash, non-cash, can be tangible, non-tangible. So please mention what is the mode of contribution. It is cash, check, movable property, services, whatever it is, please mention. How the contributions can be changed, please mention that. So how you can now, friends, this is the biggest advantage that you have over a company. One more advantage. In a company, if you want to increase the capital, if the authorize is there, then okay, you can just bring in the money. But if the author is not there, you have to apply for increase in the capital, authorize capital, fill in those particular forms, and then get the approval, and then you can do it. If you have to do a reduction, it's a whole lot of process going through the litigation and all. This is the best, friends. You have to reduce. Just say my contribution as per the original agreement was 2 crore rupees. Now, as per the supplement agreement, I want to bring it down to 2 lakh rupees, and I'll return the money to the partner. That's all. That is your reduction to contribution. You need not go through the process. Similarly, addition, you can do it. This is the one of the big good advantages that you have in LLP. Then you please mention the sharing of the profits and losses. Whether you want to share profits and losses in the same ratio equally, you want to share profits separately, you want to share losses separately. Accordingly, you can give the sharing of profits and losses. Coming to remuneration. Friends, as I said, this clause is important because if you have, as we have seen in the first schedule, if you are silent on this, no partner is entitled to remuneration. So please mention the remuneration. Ideally, don't put remuneration will be paid as per the clause 40, section 40 of income tax. Please quantify the amount. If there is a difference in the remuneration, 40A has got sufficient safeguards. Don't worry about that. But please don't mention that remuneration will be paid as per the provisions of the Income Tax Act. Please quantify. X will get so much, Y will get so much, and so on and so forth. Mention who are the designated partners. Please mention their rights and obligations. So if you want to ensure that designated partners have only the role in the management, please put in the rights. If you don't put it, then only they will have the obligations. Even if you don't put the obligations, by default they are there. And any other obligations you want to put on them, you cannot restrict the statutory obligations, but you can increase the other obligations. And if you want to give them certain rights, please do it through this. Otherwise, you cannot. As I told you, by default, they do not have any right. Then rights and obligations of the partners. So here also you can put in what are the obligations per partner. You can put it. No need of putting a general clause if you want to do it. Now, friends, what happens is, supposing you got a financier who says that you have a building project, I want to finance, but I want to safeguard my money. How it happens? So what you do is, he says, I am not interested in your day-to-day management, but what you do, whenever it relates to my money, I have a veto. So it can still, that can also be done. Such is the flexibility of this agreement, that you can clearly write that, okay, day-to-day management will be held by XYZ, but anything related to the project, that is reduction in capital, mortgage of the plot, selling of the project, then this person should have the first right to speak. So you can mention in that, no problem. It is so flexible. Then you can give clauses relating to admission, retirement, expulsion, or death of partners. How will it all happen? What happens on death? Whether you would like to take the legal heirs into consideration, whether you not like the legal heirs to come in, everything can be spelled out. Here, friends, they give you an option of assignment of financial interest, unlike in a partnership firm. So like we assign or mortgage or shares for loans, personal shares. Here you can assign the financial interest in the LLP, but assignment of financial interest does not entitle the other person to have a role in the management. You will still have a role in the management. Only your financial profit, share of profits, and whatever you are getting will go to the assignee. He will have no other right on the LLP except for claiming his profits or the financial interest. Then you can mention how the meetings will be held. Minutes will be recorded, because there is nothing in the LLP Act which says how the meetings to be held, how the minutes have to be recorded. In the Companies Act, we have that quarterly board meeting should be there, AGM should be held. But here there is nothing. Yes, you will have to hold certain meetings, which will look how do you hold it. But as of now, it is silent. So you can totally define your procedures, how the notice of meeting will be issued, 7 days notice, 3 days notice. Nothing is mentioned here. You can define your own rules. Then what are the procedures for loan from partners, the interest that is to be payable, loan from relations and friends, you can decide and put it in the agreement. Non-compete clause, that the partners would not compete with the LLP or with each other for a limited period, a territory, whatever you want to put in, you can put it. You can also put in how the banking accounts and audit would be done. And although the LLP Act puts in certain guidelines for audit, if you want to change it and you want to say that every penny of mine should be audited, you can put it and you can get it audited. Nobody is stopping you from there. Then you want to put any restrictions on the partners, how they use the funds and how they run the LLP and all that. You can also put the restrictions on the partners. And then the important clause is how the agreement will be amended. You can put the whole procedure over here. That's what I said. It is totally flexible. There's nothing mentioned in the act. So you can put in the procedure how the agreement will be amended. Unlike the procedures for amending a MOA or amending a AOA put in the Companies Act, LLP Act is silent. So you can put in the agreement amendments. Then you can put in an indemnity clause, because partners are dealing in good faith on behalf of the LLP. So they have a right to be indemnified. Then you can put in the winding up clause in there. How the resolution of disputes will be there, as I said, either through Arbitration and Conciliation Act or through courts or whatever you want to put in, you are free to do it. No problem. There is no such binding. So friends, these were the features of the LLP agreement. And there are certain ancillary clauses also which you can put in. conversion from firm, conversion on company. So if it is converted, you have to put it that this is a converted from a firm or a conversion from a company, or any other restriction. If you want to put it, you are totally flexible. It is up to your option. Whatever you want to put it, you can put it. Then what is the stamp duty on an LLP agreement? Stamp duty on an LLP agreement is, friends, nothing but the stamp duty payable on a partnership firm. Now, we in Maharashtra have a stamp duty 500 rupees for every 50,000 rupees, subject to a maximum of 50,000. And in case of a immovable property being brought in, the stamp duty that is payable on a conveyance. This may differ from state to state. So in which state you are registering the LLP, incorporating the LLP, please look into the stamp duty provisions applicable over there. Based on that, applicable to the partnership over there, based on that, you will have to decide the stamp duty. When the issue arises is stamp duty payable on conversion. Technically speaking, to me, if you go even by the part 9 decision, should not be there, but normally these people are insisting. So what we suggest is that you please go to the stamp duty officer, apply for adjudication to his satisfaction. If he is satisfied, he may not charge. Otherwise, normally they accept and they charge you a concessional rate of 2 to 3%. That is up to you how you are able to satisfy the adjudicating officer. Now we just understand the basic difference between a LLP agreement and a memorandum and article. The contents are mostly defined by the act. In case of memorandum and article, LLP is a totally free document. You can write anything which is legally allowable in India. LLP agreement similarly is most flexible, as we have understood most of the clauses, that you can put in everything that you can think of, all your safeguards, all your negative things that you have in mind, you can put in, whereas there are certain restrictions in these cases in memorandum and articles. You want to put in the restrictions, you can do. Again, it is up to you. Stamp duty also, I told you, for a memorandum article, the stamp duty is defined under the Companies Act and the Stamp Act. Whereas LLP agreement, the stamp duty is basically based on a partnership firm. Now we just try to understand the taxation aspects of a LLP. LLP will be taxed as a partnership firm. So in the Income Tax Act, there is no separate definition of a LLP. LLP is treated as good as a partnership firm. So based on that, partner share to be exempt under section 10(2)(a). So whatever is the share of profit of the partners is exempt under 10(2)(a). Returns have to be signed by the designated partners. Here again, see one more statutory obligation is put by the Income Tax Act, section 164. The returns have to be signed by the designated partners. And in case there are tax dues, here the liability goes unlimited. All the partners are jointly and severally liable for tax dues in case of a winding up. Only in case of a winding up, they become severally and jointly liable. So this is an exception to the limited liability. Section 223(1) includes LLP within the definition of the firm, as I told you, because they had said that it is a so similarly, every partner of LLP is as good as a partner of a partnership firm. LLP is a partnership. 140 is returns to be signed by the designated partners. 167C says that dues on liquidation or winding to be joint and several, which we have all learned. This is just the sections I am putting it for you. 44AD explanation A excludes LLPs from. So LLPs are not eligible for 44AD, which normally a partnership firm is eligible, but LLP has been excluded by that. Although LLP for other purposes of income tax is treated as a partnership firm, but for 44AD, it is specifically excluded. Then the introduction of capital asset by a partner, the same rules apply, 45(3). Then 115JD is a tax credit for AMT paid under section 115JC, which you are eligible. Any for a partnership is also available. Similarly, alternate minimum tax to apply to LLP. Sorry. Then 45(4) similar rules apply for taxation of dissolution of partnership, and recently amendments have been made to the transfer of capital asset and dissolution in the recent budget. That also you will have to take care. 45(4) has been amended. Then 40B remuneration and interest to partners. That restriction is there. 90% on first 3 lakh rupees and 60% of the remaining profits, and interest to partners up to 12% as of now you can give. Then 48(2) applies for payment to related parties. Taxation on conversion of LLP. Friends, this is very important to understand, because in case an LLP is converted to firm or a company is converted to LLP, then what is the tax effect? No taxation on conversion of firm to LLP if all partners continue to be partners and all rights and obligations are the same. So if you look at these, there are two conditions put in. All partners continue to be partners and all rights and obligations are the same. So when we go to conversion, you will find that when you are converting a firm to LLP, these two are anyhow mandatory, that all partners have to continue to be partners in the LLP and all the rights and obligations have to be the same. So by default, you are fulfilling the conditions. So technically, if you are converting a firm to a LLP, there will be no tax at all. But in case you are converting a company to LLP, then there are 7 conditions put in 47(13)(b). If you satisfy all the 7 conditions, then only there will be no capital gains tax. Otherwise, there will be capital gains tax in the hands of the company as well as in the hands of the shareholders. So earlier there were 6 conditions. Subsequently, the 7th one was also added. We will try and understand what are the 7 conditions in the next thing. And then 47(a)(4) has stated that in any year where any of the conditions under 47(13)(b) are not complied, then it shall be deemed to be the profit or gains of the successor LLP in the year in which the conditions are not complied. So it will be taxed in the hands of the LLP as well as in the hands of the shareholders. So what are 47(13)(b)? 3 of them, 5 friends, by default they are fulfilled. The issue is only 4. So all assets and liabilities of the company immediately before the conversion become the asset and liabilities of the LLP. You see the conversion procedure as per the LLP Act. So all assets and liabilities have to be the same. So this is by default fulfilled. All shareholders of the company prior to the confirmation have to be partners in the company and in the same profit sharing ratio, same contribution. This again is a mandatory condition while converting. So this by default you are fulfilling. You need not worry about these 2 conditions. They are by default fulfilled. This is important to understand. The shareholders of the company do not receive any consideration or benefit directly or indirectly in any form other than by way of share in profit and capital contribution. So friends, you cannot basically get any other benefit because your shares contribution has to be transferred at the same amount. You cannot have an appreciation showing or a revaluation done. So if you don't do this, you will get it. The aggregate of the profit sharing ratio of the shareholders of the company shall not be less than 50%. So in another 5 years, the existing shareholders who become the partners in the LLP cannot hold less than 50% in the ensuing 5 years after the conversion. So you have to ensure that the original partners continue for at least 5 years and continue to hold at least 50% of the contribution. The total sales turnover or gross receipts in business of the company in which the 3 preceding previous years in which the conversion takes place does not exceed 60 lakhs. When this 60 lakhs remains stagnant since 2008, 2010, it has not been amended. And mind you, this is not the average turnover. It says every year. So in the last 3 years, even if in any year your turnover has exceeded 60 lakh rupees, then you are not eligible to convert. Otherwise, capital gains would be charged. So please take note of that. And this is the biggest drawback that is happening in the conversion of companies to LLP. So basically, you can understand the government doesn't want to encourage too much of conversions. Then this is the 7th clause that was added. Earlier, this was not there in the original 6. The total value of the assets of the company as per books in any of the 3 preceding years before the conversion does not exceed 5 crores. So even if your book value exceeded 5 crores in any of the 3 preceding years, you will not be eligible to convert. Or even if you convert, you will not get the benefit of a no tax. So please take care. And last, no amount is paid directly or indirectly to any partner out of the balance of accumulated profit. So you cannot withdraw whatever the reserves are there. They have to continue as reserves for a period of 3 years from the date of conversion. Up to 3 years, you cannot withdraw your reserves. You cannot reduce your contribution. You have to continue that. If you withdraw before 3 years, then again taxation will happen. Friends, here the taxation happens in 2 ways. One is capital gains in the hands of the company because of the revaluation of the assets. The other is in the hands of the shareholder, because automatically once the assets are revalued, the value of the share that he is getting will be revalued. You might have purchased at 10 rupees, now you are transferring at 15 rupees, so you will be liable to pay capital gains on 5 rupees. So please take care. It is not only in the hands of the company but also in the hands of the shareholder. Now we see what are the effects on conversion. After conversion, what happens is double deduction cannot be claimed. So what they have said, that section 32, depreciation cannot be claimed more than what is eligible. So if you have claimed partially in the LLP in the earlier period, company in the earlier period, then in the current period you can continue for the remaining. Cost of acquisition shall be deemed to be of the private limited company or unlimited public company shall be deemed to be the cost of acquisition of the successor LLP. So it is continuing to be the same. Cost of acquisition of rights of partners shall be remain the same. No MAT credit or whatever is pending in the company will be allowed to be set off in the LLP after conversion. So you lose out on the MAT credit that was available because there is no MAT in the LLP. Then whatever VRS and all you have given, so whatever they were allowed, it has allowed, and amortization will still continue to be allowed for the remaining part. And in case the whole 35 AD has been allowed in the earlier year before the conversion, then the cost will be treated as nil. So you cannot claim further amortization. Similarly, actual cost of assets at the time of conversion shall be the WDV because it has to be taken as book value, as we have already seen during conversion. 72 has been added, that business loss. Ultimately 4713B, if you don't fulfill, again you will not be allowed to take over bundle of depreciation or business loss carryover in the LLP if you don't fulfill any of the 7 conditions of 4713B. And that says that if it is not fulfilled, then in the year in which it is not fulfilled, everything will be brought to tax in the hands of the successor LLP, because you now cannot go back to the company and visit it. It will be taxed in the hands of the successor LLP. Similarly, it applies to accumulated loss and unabsorbed depreciation. Now, friends, lot of questions have also been raised on the FDI part of what happens to FDI, whether LLP can get a FDI and all that. So initially, central government had wide press note number 1 issued in May, allowed restricted FDI by the then finance minister, our ex-president Shri Pranab Mukherjee ji, who had brought in this press note number 1 2011 series. He was the finance minister. That is, FDI and LLP is allowed in those sectors where 100% FDI is allowed through the automatic route. This was what was allowed in 2011. With these exceptions, sectors eligible to accept 100% under automatic but are subjected to FDI linked performance conditions. For example, minimum capitalization norms relating to NBFCs or township and all that, real estate basically. Sectors eligible to accept less than 100% FDI under the automatic rule sectors eligible to accept FDI under government approval route. Agriculture, plant activity and built media, they are not allowed. Sectors ineligible to accept FDI, so they are not allowed, although there may be 100% in the automatic. And who are the eligible investors? A person who is resident outside India or an entity incorporated outside India shall be eligible investor for the purpose of FDI and LLP, except a citizen of Pakistan and Bangladesh, or a SEBI registered FII, or a SEBI registered FVCI. So they cannot bring in FDI. Even they qualify as eligible investors, but these are the exemptions to the eligible investor list. Then a SEBI registered QFI, a PF, a foreign portfolio investor registered with the SEBI. These people are exceptions. Now we go to the conversion. Conversion can be done either of a partnership firm or a private limited company or an unlisted public company. You cannot convert a listed public limited company. So schedule 2, second schedule applies in case of a conversion of firm to LLP. Third schedule will apply in case of private limited to LLP, and the fourth schedule will apply in case of an unlisted company to LLP. Friends, we look at these provisions. Third and fourth schedule I'll merge because they are practically the same. Only because the words private and unlisted is mentioned, they have given two different schedules. Literally, the words are the same. We look into it. And then on conversion, the LLP is mandated to inform the concerned registering authority within 15 days of registration. That is, we have to inform either the registrar of firms or the ROC that we have got converted from a company or a firm. What does the second schedule say? Conversion of firm to LLP. All partners of firm to be partners of LLP. Form number 17 has to be filled. LLP to inform the ROF about conversion within 15 days. All the assets, liabilities, and all rights and obligations to be transferred. So this was the condition in the income tax also, if you remember. So all assets, liabilities, all rights and obligations are transferred, and all partners of the firms will become the partners of the LLP. In case any of the partner of the firm does not want to become a partner of the LLP, then you can ask him to either wait, let the LLP be converted, and then you withdraw. But either, because the point is, if he withdraws earlier, then only a registered firm can be converted. So again, you will have to go through the amendment of the deed, retirement deed, and registration through the ROF, and then only you will be able to convert. So that is one thing that you have to look into if one of the partners doesn't want to convert to a LLP. And then statement of conversion to be mentioned in all correspondence for a period of 12 months. Maybe your letterhead, maybe your email, maybe your envelope, everything has to mention that this is LLP is formed after converting from so and so firm. All pending proceedings against the firm will continue against the LLP. So you cannot get rid of all your legal liabilities. Partners continue to be liable for liabilities before conversion. So up to the date of conversion, the partner's liability will be unlimited. Only after the date of conversion that their liabilities become limited. So this will continue. All existing agreements and contract to continue as if of the LLP. So if you have an agreement with the employees or some vendors, by default they will continue, and you have to just intimate them and do an addendum to amend the name. That's all. Now, conversion of a private limited company and a public limited company, unlimited public limited company to LLP. What are the features? This is covered by the third and fourth schedule. All the shareholders have to be partners of the LLP. This was one of the conditions of 4713B also. No security interest in the existing assets. This is a problem, friends, when you got a loan, a working capital limit against a security interest. So there you have to, what you have to look into is you may have to temporarily surrender and then go back, because the condition is that no security interest should be there in the assets. Form 18 has to be filled. LLP has to be to inform the ROC about conversion within 14 days, 15 days. Friends, this is a duplication of work, because ROC is mandated once because it is the same ROC which has formed a private limited company or the unlisted public company, and they are mandated because they know that this company has converted to LLP. They are mandated to delete the name of that unlisted public company or private limited company, but still the LLP is mandated to inform the ROC at all. This is a duplication of work. It could have been avoided, but nonetheless it is there. Then again, all assets, liabilities, and rights and obligations to be transferred. So these were two further conditions. So as I said, 3 conditions are by default fulfilled of 4713B. Only the remaining 4 have to be fulfilled. Similarly, a statement of conversion to be mentioned in all your correspondences. All existing agreements and contracts to continue. All pending proceedings against the company to continue against the LLP. Friends, now we come to an important amount of accounts filing and audit. Accounts have to be maintained. Yes, they have to be maintained because here you don't have an option of 44A, and as I said, 44AD is also not applicable. So accounts have to be maintained. Statements of account and solvency has to be filed within 6 months. Now the Act says it has to be filed within 6 months of the end of the financial year. That is form number 8. But technically you can file within 30 days of the end of the 6 months. So please remember this date, that accounts and audit, the statement of accounts and insolvency form number 8 has to be filed before 30th of October every year. Friends, there are only 2 important dates in filing in a LLP that you have to remember. Apart from your regular amendments and all, I am not going into this. But statement of accounts, that is form number 8, and form number 11, which we will look into sometime. You just have to remember these 2 dates, 30th of October for form number 8. That's all. Simple as that. You need not worry about the form 4, AOC 4 and all that. Nothing is to be filed. Audit is mandatory in case turnover exceeds 40 lakhs or contribution exceeds 25 lakhs. Yes, friends, turnover exceeds 40 lakhs. This has not been amended since the Act is brought into being. This was brought when the tax audit limit under 44AB was 40 lakhs. Now the tax audit limit has increased many folds and different variations have been given in the Income Tax Act for 44AB. But still, for the audit under the company LLP Act, the limit remains 40 lakhs. So if your turnover exceeds 40 lakhs, and as far as the LLP form is taking, they include your other income in the turnover. It normally should not be there, but for the purpose of 40 lakhs, they are including your other income, or the contribution exceeds for 25 lakhs. So if your contribution exceeds 25 lakhs, and mind you, friend, the contribution will include your reserves. This is what the back-end bureaucracy has defined. Technically, it is wrong, but still they have defined that. So you have to take care of that. Audit has to be conducted by a chartered accountant. No format is given, no CARO, nothing. But yes, we have our own SA 700 and SA 700 revised, which has to be looked into before issuing the report. And then, friends, this is the second form that you have to fill in. Annual report, annual return has to be filed within 60 days of the end of the financial year. So that is 30th of May, form number 11. Form number 11, 30th May, form number 8, 30th of October. Only these 2 forms you have to fill in during the year. That's all. The fees are also nominal, ranging from 50 rupees to 200 rupees, nothing much. Yes, the penalties are heavy if you default, 100 rupees per day. And then the annual return is to be certified by a company secretary in case your contribution exceeds 25 lakhs. If it does not exceed, then you can just file the annual return form number 11 under the digital signature of both the partners. So we just try to understand the accounts and audit difference between LLP versus a company. Statutory requirement is under a Companies Act, formats have been given, balance sheet formats are given, P&L formats are given, audit is mandatory, audit formats are given. Under LLP Act, nothing is given except that if your turnover exceeds 40 lakhs or your capital exceeds 25 lakhs, you have to get it audited. No format, no system. You can prepare a balance sheet, financial statement as per your format, but the institute has issued some guidance note which has to be taken care while issuing. As chartered accountants, we are bound by that, but technically as per the LLP Act, there is no such format, no audit format, nothing. Applications of standards, yes, mandatory standards, we as chartered accountant members of the institute are bound to ensure that the standards are applicable, but there is no binding as per the LLP Act vis-a-vis the Companies Act. It says that the standards have to be followed, and violation of non-following has to be reported, but it is nothing is there under the LLP Act. Similarly, there is no pre-described format of audit report under the LLP Act as it is in the Companies Act, CARO. We have been seeing changes right up to 2021. But here there is no format. But yes, we have our own statements of audit, standards of audit, 700 revised and all. We have to look into that and issue a report based on that. Statutory audit also, I told you, about 40 lakhs, otherwise it's not mandatory vis-a-vis a company, where it is mandatory whether you have any turnover, whether you do any business or no. Then statutory filings. Company, there are many filings, MD, MN and all, so many, so on and so forth. There are many forms, MGT 7, your annual report, P&L, balance sheet, everything has to be filed. Here only 2 forms have to be filed, form number 11, 30th May, form number 8, 30th October, nothing else. Then for directors, designated partners, if you have changes within 15 days for designated partners, if there is a change, you have to intimate in form 4. Otherwise, there is nothing much. Even for other stakeholders, form number 4, you can file for any change. Vis-a-vis in case of a shareholder, the company, we file with the annual return at the year end. Here also in form number 11, it will go, but form number 4, you will have to file for any change in the partners within 15 days of the event happening. We will just try to understand the residuary clauses because most of it we have understood. Mergers and acquisitions. The provisions are similar to the Companies Act, so I am not going into details. The same provisions apply, 62, 63, the LLP Act. Winding up a disclosure, friends, resolution. Again, this is another, I would like to say, the playing of the bureaucracy. If you look at the LLP Act, they have said LLP can be wound up voluntarily. You just circulate within the partners and then you apply to the tribunal. Now it's NCLT and no issues, it will be accepted. But then the bureaucracy came into being. अरे इतना जल्दी कैसा हम जाने देंगे, हमारा power कैसा जाएगा? So they came into being. LLP Winding Rules 2010. What does it say? All the provisions of the Companies Act 56, Section 460 and onwards relating to winding up of the company will apply. Going to the court and all that. Nothing, a blanket notification, finish. Hamara power kaisa jayega? We want to hold everything. Then they brought in the LLP Winding Rules 2012, which are still applicable. They just simplified a bit and you can go to NCLT and all that. But initially, as I said, if you see in the Act, the winding up procedures are very, very simple. And basically, as per the Companies Act 56 to be applicable. Now, friends, this was all the legal issues. What the Act says, what the law says, the rules say, Act says, this is what we have understood. But now I would like to guide you for certain, it will just take 10 more minutes. I will guide you through the legal aspects and the documentation, which is not there anywhere in the Act, but this is only by experience that we have built it, and it will help you in maintaining the records. Documentation in a LLP, it can be classified into a master data, statutory records, ancillary records, and recurring records. These are my 4 classifications that I have defined, and we will be looking into every classification, what type of documents we mention in there. What are the master records you should maintain? Certificate of incorporation, form number 16. LLP agreement, because as I said, it is the most heart and soul of every LLP, it has to be mentioned. Supplementary agreements, if any. So as and when you are amending the LLP agreement, you file supplementary agreements, you have to keep. list of partners and consent of the partners. Friends, here when you are having a partner, you have to obtain the consent of the partner. As in a company, when we take the consent of the shareholders in the beginning in the memorandum and article, that yes, we intend to be shareholders here also, but every time there's a change in the Companies Act, you have to just get the share transfer form. You have to obtain the consent of the partners over here. So ensure that the consent of the partners is available with you at any point of time. Similarly, for designated partners, you also have to obtain their consent, and that should also be part of your master records. Resignations of the partners has to be there, and the forms that you fill in with the ROC form number 9 for resignation, that has also be there with you. Resolutions for amending the LLP agreement, including relating to clauses like admission, retirement, change of objects, change in contribution. So all the resolutions of your partners meeting, which are done for amending the LLP agreements and getting the supplementary agreements, should be there in the master record, because they especially relating to these points. Then the second classification, as I told you, is the statutory records. So what would it include? The statutory records are your PAN number, PAN card, your TAN number letter, your GST form number 6, GST registration number, IEC, PF, profession tax, ESIC, whatever you got, these registration copies you have to keep with you. Minute books you have to keep, although there is no procedure given, but yes, you have to maintain the minutes of the meeting. So minute books you have to maintain. Copies of all the resolutions that you are passing relating to applying for registrations or maybe approval of accounts and all that, you will have to keep. Copies of returns including ROC. As I said, ROC, there are only 2 forms annually, form number 8 and 11, and apart from other filings, if at all you have done, you have to keep it. Income tax, GST and others as and when they are applicable, and other statutory submissions that you are doing for other acts. So these are your statutory records. Ancillary records would include your agreements and contracts with maybe employees, maybe vendors, maybe third parties, maybe international agreements, whatever you are doing, maybe trade agreements. So that will be part of your ancillary records. Ownership records of your properties, whatever properties you own, the ownership and all that. Auditors and company secretary appointments. So as and when you are doing appointments for auditor and company secretary, all their appointment letters and all, you don't have to submit a form to ROC, unlike in case of a company, but still you should have appointment letters and their consent with you, which is important. And the copy of the audited financial statements, or at least the financial statements, if they are not audited, they should be there in your records over a period. And then audit reports from statutory audit, maybe tax auditors for 44AB, GST, excise and VAT as and when applicable. So if at all it is done, please keep a copy of them. And ancillary records would include your details of your bank accounts, authorized signatories, resolution relating to that. If you have policies and operational manuals in your LLP relating to employees, code of conduct and all that, you can keep over there. And lastly, the recurring records. That's your regular books of account, fixed asset register, your excise records if applicable, legal records like PF register, salary register, etc. So friends, these are basically the 4 classification and the documentation that you have to maintain. And we just have a look at the meetings. Please issue proper notice in accordance with your agreement, LLP agreement. If you have stated a procedure, that a 7-day notice, early meeting, urgent notice free, it is all you have to define. Nobody has defined, the act has not defined, but issue proper notices, maintain proper minutes as per the agreement, then maintain attendance records of the partners present. Because friends, this is important. I have received cases where there are disputes, and because these records are not maintained, the partners are facing very big legal issues in courts. So please maintain all these records. And then we also have to look into the statutory obligations that we have. ROC, there are only two basically: annual return and statement of account, form number 11 and form number 8, 30th May, 30th October. Apart from that, any change that you do within 15 days of the amendment, you have to file, whether a change in the partner, change in the agreement, whatever it is, within 15 days of the date of the event. Then income tax due dates, we all know, returns and audits, you have to take care, GST and allied laws, PF returns, and also you have to ensure that everything is filed in time and the records are maintained. Friends, this was it. This was all from me for the presentation. I thank you for giving me a patient hearing. And again, I would like to thank Thane branch and especially Chairman Asawaji for giving me an opportunity to present my views. And I am ready for questions. Thank you, friends. Yes, Asawaji.
Yes, sir. This is Rajneesh.
Yeah.
The first question is from CA Manilal Shah.
Yeah.
His question is, can we have asset sharing ratio in the agreement, LLP agreement?
Asset sharing ratio. Normally, asset sharing ratio would apply only in case of a dissolution. So yes, you can put in what would be there in a dissolution.
Okay. And next question, one second, is from CA Swapnesh. He's asking, is there any mechanism for condonation of late fees for delay in filing of the returns?
There is no condonation of late fee. They had come out with a LLP settlement scheme which ended on 31st of December 2020. Subsequently, there is no condonation. You have to pay 100 rupees. Even there are procedures for compounding, but still you can, they have to be looked into. Technically, if you just go, there is no condonation process.
And third question is from CA Monica Sharma. Her question is, what is the procedure of change of registered address of LLP? And does the, oh, sorry, this one here.
Change of registered address, you have to intimate along with filling form number 12 to the ROC along with a proof of the address, party of the resolution, and also form number 3 you will have to change with a supplementary agreement changing your registered address. 2 documents you have to file.
And within how much time, sir?
15 days. I told you everything
yes,
within 15 days of date of event.
Yes, sir. And if the firm is getting converted into LLP, whether the PAN number changes? This is question from CA Lakshmikant Kabra, sir.
There are 2 views to it. Many people have been continuing, but technically, if it is a firm converted, I would still suggest that you please apply for a new PAN number and get a new PAN. Because if you see, there are certain, as I said, there are certain liabilities which are applicable till the date of conversion and all. So to avoid that, you better have a separate identity totally. If you continue the same PAN number, then the identity confusion will remain.
Yes. Then the next question is from CA Manish Garg. If the designated partners do not bring in full amount of contribution as stated in the LLP agreement, even after the completion of 2 years of formation, then as auditors of the LLP, should we qualify the report, or would it be okay to put any observation and notes, or not mandatory to report anything?
You have to see the agreement, what are the conditions put in for bringing in the contribution. And as I said, it doesn't affect whether it's a designated partner or a partner. Every partner has to bring in a contribution, not a designated partner. So the contributions are to be brought in by partners. They may also be designated partners, is a different issue. Contributions are brought in by partners. You have to see the agreement, what it's, as I said, it can be a staggering bringing in. So if the agreement says that it would be brought out in a staggering way, how it will be brought in, and if nothing is mentioned, at the most in the report, he can say that only this is the amount that is contributed and the whole amount is not contributed. There is no such binding, and nothing as per the company is like in the company law, we have that within 1 month the contribution has to be brought in. There's no such regulation in the LLP.
Thank you. And CA Prashant has the next question. Is there any limit or restriction on withdrawal of reserve amount by the partners?
There is no restriction except if you have converted from company to a LLP, then for 3 years you cannot withdraw a single penny.
CA Pradeep Kumar has mentioned something. Section 44 ADA presumptive taxation applicable to LLP for assessment year 2021. So this is his stand.
Yeah, but it was, I think, for 2021 or 21-22 that he has to verify. Earlier it was not applicable up to 2021 also.
Sir, it was applicable.
ठीक है भाई.
Clause amendment लिया ना अभी.
21-22 से है ना भाई. चल ठीक है, we'll proceed.
वही confirm कर दूँगा. Thank you.
Thank you, sir. CA Ashwini has the next question. Can a person disqualified to act as a director be a designated partner in LLP?
There is no such disqualification.
Okay.
Rajnish, I have one question.
Sorry.
I have one question. It is a technical one.
Girish, I think let this question answer complete. I will take it to your question also later.
Yeah. Okay. CA Swapnesh again. Can a partner in his personal capacity provide services to LLP firm?
Yes, if your agreement does not restrict it.
Example, a CA and a partner in LLP partnership. He is providing fundraising services in his personal capacity to the LLP firm. Can he charge professional fees for the same?
I am telling you here, if you are a chartered accountant, then you have to look into the code of ethics of the institute also, as well as the LLP agreement also, whether it allows you to provide services. Again, everything depends on the agreement.
Okay, sir. There are no more questions right now. Girish, sir, could you please go ahead with your question?
Okay. Vijay.
Yeah.
I have one technical issue.
Yeah.
My CA membership matches with my CA membership number matches with the DPIN number of some defaulted partners.
Huh?
So my membership number is 1.
Girish, I cannot hear you.
Rajnish sir, next question.
Hello,
Yeah.
Vijay sir. The question which was put up in the chat box was that for the contribution was not brought in by the partners after 2 years of formation. So as an auditor, what should be our role?
I said first your role is to check the agreement. What does it say? When is it to be brought in? What does the agreement say? Whether it states a time limit to be brought in? Because the act doesn't give you any time limit to bring in the contribution.
Thank you, sir.
Girish, can you come again?
I believe Girish, sir, actually.
Hello.
Yeah, Girish. Yeah, Girish.
I have one technical question.
Yeah.
My membership number, CA membership number 117453 is matching with the DPIN of the person who is defaulted.
Yeah.
So I am not able to upload any audit reports in with my DSE and with my membership number.
That you have to speak to the ROC, because these are two different things. Because when you are signing a report, they clearly says the membership number of the auditor and the DIN number is totally different.
Yeah, but they are
there's nothing like DPIN. The DPIN didn't have been merged. It is the same thing.
So DIN of the person who has defaulted is matches with my auditor.
So that you have to speak to the ROC to get this technical hitch solved.
I spoke
It is
to
an
the
issue
person.
at the end, software issue at the end of the ROC that has to be sorted out.
Yeah, so I have to get all the audit report signed by the issue Bhagwan Asawa.
Yes.
Okay, thank you.
If there is no more question, then
one question is there, sir.
Okay.
Yeah, CA Sanjay, sir. His question is: will track record of LLP be considered for SME IPO track record purpose?
Whether the LLP can go for IPO, that you have to see.
No, sir. The question they mean to say probably is the track record probably it might have been LLP might have been converted to.
Yeah, but then
public
if you are
limited.
going for
But
this
then
thing,
that LLP's track record, whether it will be considered for SME IPO or not.
Sanjay
I guess
ji,
that is the
he's
question.
saying conversion from LLP to SME.
Exactly.
Now I would like to draw your attention to section 366 of the Companies Act 2013. It gives an option to 1956 never had because there was no LLP. 1956 Act did not allow a conversion from LLP to company. Companies Act 2013 states that a LLP can be converted to company, but the rules have not been notified. So as of now, no LLP can be converted to a company. Until the rules are notified, I think we are wrongly discussing that issue. The rules have to be notified and then only we will be able to convert a LLP to a company. And then yes, definitely the track record will be checked because you are ultimately relying on the track record for going for IPO and getting funds.
Yeah, no more questions in the question box, sir. Thank you so much.
And just a clarification to Pradeep Gupta. Pradeep Gupta, when I said 44AD, 44AD and 44AD are different. Please take care.
Okay, thank you, friends. Before we move ahead with formal vote of thanks, I have two announcements. One, we have only women CA seminar on 20th. Again, timing is 5 to 7. Then our Vocal for Local Series 3 will be on 28th, 29th and 30th. Kindly, necessary announcement will send through various medium, particularly WhatsApp, but keep your date book. We have a Vocal for Local Series 3 on 28th, 29th and 30th. And now I request Rahul Gharat to present formal vote of thanks. CA Rahul Gharat, please proceed.
Thank you, Shiv sir, for allowing me to give vote of thanks on Vijay sir's lecture. I'm very glad to do so. So the takeaway from today's session: no reserve required, but Form 8 says please mention reserve. So there is a dichotomy. Partner can grant loan, agreement can be uploaded post incorporation. Even if we make mistake in stamp paper, don't worry now. It can be ratified. Now here on we can draft the agreement based on the check points shared today by Vijay sir. All the integrities related to income tax, ROC of conversion to LLP has been well explained by sir. So it is much simplified compared to private limited company compliance, which is if we consider today. So thank you, sir, for delivering such a wonderful session and briefing such good highlights on behalf of Thane branch and on behalf of members and you all members for listening so calmly and for all the questions being shooted to Vijay sir, which were well asked by delivered by Vijay sir again. So thank you from all behalf of Thane branch once again. Thank you, sir.
Thank you. I would again like to thank the chairman and the team Thane branch for giving me an opportunity to present my views on this topic, which is very near to me, dear to my heart. And I would have suggested my book LLP 275 frequently asked questions, but the problem is it is out of print, and I am in the process of working out the revised edition online and will get back to you. Thank you.
And one more request, Vijay sir, that if you possible, if you can share this presentation on WhatsApp, then
already done, Chairman sir.
You are super fast.
You can check your WhatsApp; it is there.
You are super fast. That's why I called you. You have omnipresence. Whether it is WhatsApp, mail, or something, sab jagah presence hai bhai. Now, Kavita, can you close the recording? Yeah. Now, formally, we can.
Even Facebook should be off when we are discussing.
Yeah, Facebook. I think probably it is off. Kavita, can you?
Facebook is on.
Sir.
Facebook is
live,
on.
Sir. Yes.